Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday, September 17th. Hope you guys have a wonderful day and enjoyed a great weekend. We got one item on the economic calendar today, and that is the Empire State Index. This is the manufacturing on the New York region for the month of September. So in August, we had a 25.6 on this index, which is a great number. But unfortunately, we disappointed this month for September to 19 on there. So a lot of economists were kind of thinking right around 23, but it dipped much further than what we would have expected on this. So they say it's a little disappointing on this. Stock market is currently down right now, and it's basically taking its cue from increasing tensions with China. Apparently, President Trump announced that looks like they're going to proceed with implementing the tariffs on the $200 billion of Chinese goods. Initially, it was at 25%, but it looks like now it's going to be at 10%. This isn't going to do too much to China, primarily because this basically makes up the difference on the loss of their yuan versus the dollar. So basically, it's just going to even it out a little bit with that drop in the yuan compared to the dollar. So as a result, China's kind of threatening that they're not going to come back to the table if they feel like they have a gun pointed to their head. So this is increasing tensions between the two countries and possible trade talks, and could potentially escalate further here. So the stock market is kind of pulling back a result because this could affect a lot of different companies, as they are these days more international. And you got companies like Amazon, which a lot of goods come from over China, and those goods may be difficult or, of course, go up in price. So again, as tensions rise, is as a global level, everybody's kind of watching this. Let's kind of move forward here to see how this is playing out in the bond market. Bond market, disregard that, it's the same thing as this. It's we started off much lower, so pricing did get worse early on for pricing. Currently, we're down about 5 basis points from where we left off yesterday. We're fighting to try to stay above this line, this floor of support here. And it's very important that we stay here because we could easily drop another 50 basis points, which translates to a half a point or rise of about approximately a quarter of a rate to the rate. So rates could go up another quarter. So we're on this downward trend, as you can see here. The trend will continue going down as less people are buying mortgage-backed securities or treasuries. Stock market's doing well. There's really no incentive for them to really buy into it at this point. So meanwhile, the prices keep coming down in mortgage-backed securities. Thus, yields and interest rates keep rising as a result of it. So speaking of yields, we are trying to keep this ceiling of resistance. It did touch at the 3.01 level here. We're currently at about 2.99. Trying to break above this, because if this goes up, we'll go up to probably about 3.11, which will basically translate to what we talked about, the half point adjustment in the rates. So again, very important to see if we can at least kind of stall this a little bit for those who are out there with purchase or refinances and have not yet locked in. You may want, again, keep looking into locking in at sometime soon. Again, it doesn't look like this could slow things down, but most likely, again, it won't be down for too long. All right, folks, that pretty much wraps things up. Rates have climbed a little bit because, as you saw earlier, it started off even lower and it has pulled back a little bit. But again, it's a little bit pricing is a little worse today. But if you guys want to see any change in the rates coming in or change in the market, feel free to come over to Twitter. I do post those throughout the day at Mike Bjork. You guys have a great rest of your day. Thanks so much for watching. Look forward to see you guys tomorrow. Bye-bye.